In February, I made a video hating gold. I told you that it's a bad investment and that hedging is for idiots. Guess what? I'm the idiot because I have bought gold, a gold ETF. I already sold the gold and now I have a gold miner as one of the largest positions in my portfolio. What changed my mind and why do I think that gold will go to 5,000 US dollars by 2030? This is what we'll look at in this video today, and before that, please make sure to smash the like button. It really helps with the YouTube algorithm, and also please subscribe and hit the notification bell so that you don't miss the next video, which will be about an essay which Warren Buffett wrote in 1984. A great essay, very important essay to read. So please subscribe and also like. Now let's talk about gold. Why do I think that gold will go to 5,000 US dollars before 2030? First, let's understand what is gold. I still consider gold not as an investment. It is not a value producing asset. If you have this, let's assume this is gold, this is made up of gold, you have this today, you won't have more gold tomorrow, you won't have more gold in 1 year, even in 10 years. So gold is not a value producing asset. The same thing can be said about the US dollar, about any fiat currency, about silver, about Bitcoin, about Ethereum, about anything else. It's not like real estate. Real estate, you invest in real estate, you get a rent. So there is cash flow, it's producing more and more value to you. And if you invest, let's say, in stocks, there is cash flow, the company is growing. So it is a value producing asset, but not gold. It is just a piece of metal. And unlike other commodities, it has very little industrial use. Gold is only used for investment and for jewelry. Commodities such as silver, even platinum, all these metals, they have other industrial use. Silver is actually the best electrical conductor. Copper is everywhere in all wiring. There is a wire here, there is copper there. But the only reason for you to have gold in your portfolio is as a hedge against uncertainty. If there are uncertainties in the market, in the stock market, in the bond market, in the cash market, in the money market, everywhere, people will always buy gold. People have been doing this for more than 5,000 years. Gold has been a store of value in such a way, but gold itself is not a value producing asset. I certainly can't predict gold prices, but there is a high probability, in my opinion, and I will tell you why, that gold prices can go up to 5,000 US dollars or even higher before 2030. First, let's look at the historical price of gold. We'll look with inflation and also without inflation to understand what really moves gold prices up. If you look since 2001 to 2011, gold prices, if you are ignoring inflation, moved from 260 US dollars per ounce to 1,800 US dollars per ounce. So this is an increase in price by 6.7 times. In only 10 years, gold prices increased by 6.7 times. For stocks, usually 10 years, stocks will increase by 1.5 times, that's all. But you see this large increase in gold prices. So what happened during that period? There was the war in Iraq, there was the financial crisis, the global financial crisis, there were the wars in Libya, in all these, the Arab Spring, all these events, and also the Euro crisis. All these events caused gold prices to go higher. Gold prices gained so much in just 10 years. But will it happen again in the next decade? Well, we should also admit that gold prices fell from 664 US dollars to 260 from 1980 to 2011. So what happened during this period? It was a period of stability, of growth. The Soviet Union collapse. So there were no big political event, political unrest, or any financial unrest that could move gold prices higher. And also there was a period of high interest rates, and with high interest rates, bonds were very attractive and saving money was very attractive. So people were saving money and all of that. That's why gold prices did so poorly during those 20 years. Because there was no need to buy gold, there was no need for any hedge. There is no way to precisely predict what will happen to gold prices. It can go either way. It can go up to 5,000, it can even fall to 800 to 500. So we should not try to predict what will happen. But we should look at different scenarios and see which one are more probable. And if you see that it is more probable that gold prices will go up, then it's a good idea to have a little gold in your portfolio, or even a gold miner. But now if you see it is more probable that gold prices will go down, so it's better to sell the gold. So you should always look at the risk and the reward. You should always analyze the different probabilities before making an investment, before hedging or anything like that. But to understand why I believe gold prices will go to 5,000, we should look at the article that Ray Dalio wrote, The Paradigm Shift. He wrote this on LinkedIn, and I've read it for so many times now, and every time I'm reading it, I'm finding something new, something that I missed the last time. Ray Dalio says that the last 10 years for the stock market has been the best for the last 40 years. This last decade has been the best for the stock market, the US stock market, for the last 40 years. And this is also his argument why you should not invest just in America right now. You should invest in also China, in other countries. It's because people expect things to happen again. It's because the last 10 years have been so great that people expect the next 10 years to be great. But it doesn't look so great. Even in Europe, things do not look so great right now. And also there have been a lot of money printing going on, a lot of quantitative easing, a lot with the low interest rates. You will see that in Europe interest rates are 0%. In Japan, the Bank of Japan has been buying ETF containing stocks. So the Bank of Japan is buying equity. This is a sort of socialism. In Europe, the European Central Bank is buying corporate bonds. So there is a lot of manipulation in the market. They are trying to keep the market high to prevent a next recession. And all of that are leading the economy all around the world to uncharted territory. For example, with the negative interest rates, negative bond yield. There are more than 17 billion US dollars right now in the world with negative or zero yield on bonds. This is something that we have not seen ever.
I can't reconcile a 5% budget deficit in a world of low unemployment, low interest rates, negative interest rates in many countries. No economics textbook I know that was written in the first couple thousand years discussed even the possibility that you could have this sort of a situation continue and have all the variables stay more or less the same. So I think it'll change. I don't know when, I don't know to what degree, I don't know what part of it will change, but I don't think this can be done without leading to other things. In economics, like other things, you can never do only one thing. And we will look back this period and be surprised that we didn't see what was coming next.
There's one name for all these things. They can call it quantitative easing, they can call it whatever they want, lowering interest rates or monetary policies. It's only one thing, printing more money. And governments are printing a lot of money and they're making more promises. There is this divide between the rich and the poor. There is this wealth gap. It's true. It's because of money printing. Who are taking advantage of the money printing? People who hold financial assets, and this is creating a wealth gap. And now there are socialists coming, for example in America, saying that there is this wealth gap and we should tax the rich and we will provide more entitlement. With entitlement, of course, this means that there should be more money printing in the future, and there will be a point when the Federal Reserve System, the Bank of Japan, the European Central Bank, the Bank of England, and all major governments around the world will lose control. They will not be able to print more money because the money itself will lose its value. There will be stagflation. What will happen then? People will buy gold. And if we have seen that gold prices rose by more than 6% in 10 years, there is the probability of this happening again. And according to Ray Dalio, the paradigm shift is that the gold prices fell during the last decade. Since 2011, when it peaked, and even today, you will see that gold prices are more or less falling. But the next decade, according to Ray Dalio, will be a good decade for gold prices. There is also China as a rising power, which will bring more and more uncertainty, political uncertainty, all around the world. But we cannot predict for sure that gold prices will go up. And in my opinion, investing in gold, like I told you, is a bad idea because it is not a value producing asset. The best way to take advantage of rising gold prices, the possibilities of gold prices rising, is to invest in the appropriate, in the right gold miner. And that's why I have invested in Polymetal International, which is one of the largest gold miners in Russia. They're also one of the largest silver miner in the world. And I'm not investing in Polymetal International because I expect a recession next year and I want gold prices to go to 2000. If it goes, it's good. I'm investing in Polymetal because I see the opportunity for the long term. Polymetal International are investing a lot in acquiring new mines, in developing new mines, and with these new mines, they will expand their operation, they will expand their number of gold assets that they own, their reserve that they own, and that's what I'm investing in. So I'm investing in gold for the long term, for the next 10-15 years. So now what should you do? Should you put 50% of your portfolio in gold, 80%, 100% if your gold prices will go up? No, you should not do this, because gold is very volatile. And like I told you, there is nothing that is pushing gold prices higher. It's not like other commodities that there is supply and demand. Here it's only hedging, it's only optimism and pessimism. It's psychology of investors that will push gold prices up or down. So you should not put too much of your portfolio in gold or gold miners. I believe that the appropriate is 10 to 15%. It depends on you. If you want 15%, you put 15%, but I don't advise you to go higher than 15%. If you want to put 9%, you can put 9%. But for now, 10 to 15%, I believe is the best to have in your portfolio in either a gold miner or gold itself or a gold ETF. Now, what will happen if gold prices go lower? If gold prices go lower, the gold miners also will go lower. So you buy more if gold prices go higher. Let's say you had 10% of your portfolio in gold, gold prices rises to $2,000 per ounce, and now 15% of your portfolio is in gold. So you sell these 5%, you take your profit, you invest somewhere else. You should always trim the position, because like I told you, don't rely too much on gold. Gold is not an investment, it is a hedge, so don't rely on it. It is good to have this hedge, I believe, in your portfolio. I was wrong when I told you in February that hedging is for idiots, because I learned a lot. I learned from Ray Dalio. I read his article. I read some part of his books, and I understand his logic behind why you should invest in gold. So let me know in the comments whether you have gold in your portfolio or gold miners. Thank you for watching this video. Please like, subscribe, and share. Please watch these two videos here if you have missed them. They are here in this window and the next window. Have a nice day and goodbye.